Good morning, everyone, and welcome. It's brilliant to see such a strong turnout this morning, so thank you all for joining us. I'd like to start by thanking Aubrey Capital Management and LarrainVial for bringing us all together, as well as our speakers for sharing their time and insights with us this morning. Okay, before we begin, I'd like to take a moment to appreciate the remarkable setting that we find ourselves in today. It's absolutely stunning, isn't it? My dad is a carpenter, so I've been sending him pictures all morning. The Carpenters Company has been based on London Wall since 1429, and this site has witnessed some very extraordinary moments in history. The original hall survived the Great Fire of London. Later halls endured fire, war, and rebuilding. And following the devastation of the Second World War, Carpenters Hall once again rose from the ashes to become the building that we see today. In fact, after the Great Fire of 1666, when the City of London had lost its administrative base, Carpenters Hall became a place where plans were made for rebuilding the city itself. And that feels rather fitting for today's discussions. Emerging markets are often viewed through the lens of uncertainty, disruption, and short-term headlines. Yet, as investors know, some of the most compelling opportunities are often found in resilience, adaptation, and long-term growth. Just as this building story is about looking beyond immediate challenges to what comes next, today's conversations are about looking beyond the prevailing narrative to understand where the opportunities may lie in emerging markets today. Last year, one of the big conversations was around whether emerging markets were back. This year, that question feels rather different. We're operating in a world dominated by geopolitical headlines, trade tensions, questions around artificial intelligence, shifting supply chains, and most recently, renewed concerns around the Middle East and the Strait of Hormuz. Against that backdrop, today's discussion isn't really about whether emerging markets are back, it's about where the opportunities are now. Where are the opportunities beyond the narrative dominating markets and headlines? Where should investors think about allocating to across regions, sectors, themes? And how do we distinguish short-term noise from long-term investment opportunity? What makes today's agenda particularly valuable is that we're approaching those questions from several different perspectives. This morning, Jose Manuel Silva and Andrew Dalrymple will take us through Latin American economics and politics to the long-term growth trends reshaping emerging markets. Lo Giose and Nicholas Hopton will then help us connect the dots between commodities, global trade, and geopolitics, offering insights into the forces shaping markets beyond the headlines. In many ways, that's what makes emerging markets such a fascinating investment universe. There is no single emerging market story. There are multiple stories unfolding simultaneously across regions, sectors, and economies, each creating their own risks and opportunities. It's also worth briefly recognising the partnership behind today's event. Aubrey Capital Management and LarrainVial have been working together for several years, bringing together complementary expertise and perspectives. So Aubrey is well known for its quality growth approach and focus on long-term drivers of wealth creation and consumption, while Aubrey brings experience in asset allocation and Latin American markets. Together, they offer this broader lens through which to understand emerging markets. And that's reflected in the mix of voices you'll hear today. So whether you're looking for regional insights, macro perspectives, investment ideas, or simply a better understanding of how the emerging markets landscape is evolving, I hope you'll leave with plenty of food for thought and some full bellies too. Thank you again for joining us, and to the Aubrey and LV teams, thank you for inviting me to be your chair this morning. Our third speaker today brings perspective on the links between developed and emerging economies. Lo is an investment manager at First Avenue, and he will explore how global demand, commodity markets, and resource-rich emerging economies remain deeply interconnected. Please welcome Lo Giose.
Thank you very much, Aubrey, Aubrey Capital Management, for having me over. My colleague George is in the room here. I'm looking forward to spending the day with you, talking to a little bit more about the topic that I'm going to expound on right now, but also about South Africa. First Avenue is an asset management firm based in Johannesburg, South Africa. It's not very sexy to say that. You're from South Africa. But the gentleman asked a question, outside of South Korea and Taiwan, where is the next most glaring opportunity? And it's in South Africa. I'm going to try to weave together a few complex points here that hopefully come out well. So there's a gentleman called Akamatsu, a Japanese economist back in the 1930s. He coined the term flying geese. And really what he was referring to there were countries that developed through idea and technological diffusion. Now, when we say technological, it wasn't technology like today, it was manufacturing technology. So you can see on this chart, the top left-hand corner of this chart, that he used Japan as an example. That Japan started off its core competency in manufacturing the textiles industry. And there's a gentleman called Ricardo Hausmann, he's a professor at the Kennedy School of Government. I think he used to be a minister in Venezuela or someplace in Latin America or South America. And he talks about how countries develop by simply expanding their core capabilities or their core competencies or their comparative advantages into adjacent areas. So you can see in Japan, they went from textiles to chemicals to steel to cars, manufacturing cars, then electronics, okay? But as Japan became more and more advanced and more developed, it catalyzed change in countries in the region. Now, how did it do that? Through companies. Corporate Japan became agents of economic development, economic growth, and economic change in those markets. So Japan was the first goose to leave its tree, and it flew out into new industrialized markets, into Asian markets, into China, and of course, other nations followed. China took over next, and now you can see the next pair of goose that are trying to get out, countries that have companies that are trying to expand out. Vietnam, okay? So this is how countries develop. They develop by actually having companies inside those countries grow to a certain point, saturate the market, and then look for new opportunities. Now, you look for new opportunities on the basis of your core competency. Now, on the right-hand side, there's a chart. You can see Matsushita, which is an electronics company, used to be an electronics company in Japan. And by these accounts, they had about 20 operations outside of Japan. So you manufacture in your country, you grow up to a certain point, and you open up manufacturing hubs in other countries, and you gain scale. So when you think about it today, Toyota makes significantly more cars outside of Japan than it does in Japan. And at the time that Toyota expanded, the profits weren't soaring yet because they're spending so much money in CapEx, setting up new factories and plants around the world. But once those reached scale, Japan became a highly valuable country because not only did earnings come through, or revenue come through, earnings came through, cash flow came through, and the size of Toyota in the Japanese market was just enormous. So that's really how one really should think about the development of emerging markets. Is number one is, can you find flying geese inside those markets? Bearing in mind that there are sitting ducks in those markets. So companies that will never go anywhere. They'll look cheap and they'll be cheap forever. But inside of those markets, there are also ducks that fly like geese. And I'll explain to you what the difference between those is. So look at the flying geese. It's really worth paying attention to flying geese as opportunities. It's really worth it. And the reason why it's worth it is because you will not become a successful multinational, coming out of an emerging market into the rest of the world, if your corporate governance does not converge to global standards. Now, if we just circle back to South Africa, South Africa has one of the strongest codes of corporate governance that isn't just a tick box exercise, it's actually codified in a statutory way by law. So it combines a code of governance that has legal ramifications if you do not, if you lie about them, you have to apply and explain, okay? That's how you become attractive to even expand into international countries as a flying goose. But these are examples of companies. I think the gentleman that just spoke here talked about some of them. These are examples of companies that have simply outperformed the MSCI EM by miles from different reasons. You can see on starting on the right-hand side at the end that way, is a company in South Africa, a consumer company, which our friends at Aubrey maybe can look into. ShopRite, Standard Bank, you come this way. There's SK Hynix in there, and LG, and Samsung, TSMC, but BHP Billiton Mining Company, Mobile Telecommunications Network, Anheuser-Busch, Richemont. Now, one of the things that these companies have in common is that they are now intertwined with global supply chain systems. Yes, emerging markets have a richness of population. They call it a demographic dividend. But the spend per capita, companies that monopolize seaborne trade in terms of exports and imports, value, not volume, value, is in the developed markets. So the question is, do you arbitrage factors of production in EM to expand, to export to DM and capture that value, or do you set up factories in DM? Well, of course, the way that Donald Trump has it now, you have to set up factory in DM to capture the economics of that market. But look at all these companies here. They've expanded outside of their local countries. Not all of them, actually, but most of them. SK Hynix hasn't yet, but it's going to get there. TSMC has expanded into DM, into the United States. I think they're going to set up a plant in Japan also, in fact, in Japan. But the expansion comes at or is facilitated by the ability to arbitrage factors of production in the country to expand into, and then export, and then produce not just for local consumption, but for global consumption. And it's really, really worth finding these companies. In South America, you may all be familiar with a country called Mercado Libre that has 18 operations on the continent. But look at its performance relative to the MSCI EM index. But I'm not just asking you to look at its performance. Look at its corporate governance, right? You will converge to global best practice, whether or not you like it. One of the things that companies do also is that they catalyze a rethink, a review back home of policy. So when you think about South Africa now, it has one of the most liquid currencies in the world. It has a top 10 financial system in the world. It has a high penetration of banking services, a high penetration of mobile telecommunication services, right? I always ask myself, what is missing? What is missing for South Africa to become a developed market, stock market? What is missing? I really can't find the reason, because it's so far ahead of Taiwan, so far ahead of South Korea, from a corporate governance, from a capital allocation standpoint, protection of property rights, protection of patents and trademarks, one of the best Roman Dutch law system and common law systems in the world. The country just has to do a better job of locking up politicians, corrupt politicians. But beyond that, from a corporate competitiveness standpoint, quality of management, quality of capital allocation is outstanding. You look on the right-hand side, The blue bar there is a company called Outsurance. This is one of the best, I would like to say the best, but it's probably the second best after Progressive property casualty insurer in the world. Now, look at the flying goose here. The company was founded in 1990 as a non-agency, meaning direct online property and casualty insurance company. Extremely profitable. Moved to expand operations into Australia. It's dominating that market. Now it's expanded operations to Ireland. Will likely dominate that market. It's taken its corporate governance, it's taken its competitive advantage, it's taken its capital allocation, and it's listed on the Johannesburg Stock Exchange. So if you want access to some of the economics domestically, but you want to diversify that so that you are not just held hostage by local legislative concerns or maybe being crowded out by domestic concerns. Playing emerging markets through flying geese that take advantage of higher incomes per capita in developed markets whilst taking advantage of the demographic dividend in emerging markets. It's an incredible combination. I think it's the best way to do it. These are different sectors I wanted to show you. In the consumer discretionary sector, compare one of the best consumer companies in emerging markets. I don't actually think there's a supermarket in emerging markets or even in the world that has higher operating margins, profit margins, has a higher free cash flow conversion that's over 100%, has a higher return on equity than ShopRite, and has probably about 34% of the local market and has expanded successfully with great restraint into Southern Africa. I'm comparing here ShopRite to Walmart. Your comfort zone is Walmart. But to look at the performance of ShopRite metrics, not share price, fundamental metrics of ShopRite versus Walmart, two significant giants in their markets on the consumer discretionary basis, you can see you are not giving up anything other than maybe currency risk. You're not giving up anything other than currency, which you can hedge out if you wish. But if you look at global luxury, Richemont versus LVMH. If you look at universal banking, we have Standard Bank versus Wells Fargo. Again, you're not giving up anything fundamental, nothing, except currency. If you look at global beer, Anheuser-Busch versus Heineken, you could have put Carlsberg in there. You're not giving up anything. The corporate governance of those three businesses, the capital allocation of those three businesses, Anheuser-Busch obviously had a few missteps it's recovering, but the corporate governance of ShopRite, the corporate governance of Standard Bank, the ability to extract the population dividend out of emerging markets at a rate that de-risks your investment is outstanding. Here's some more sectors which you know very well. BHP Billiton is an Australian miner today. It really was founded in South Africa out of the aluminum plants down south called Hillside. And they had a joint venture with Broken Hill Properties in Australia. Bar none, it's the finest mining company in the world. Bar none. BHP Billiton actually behaves from a risk and volatility standpoint like an industrial company, not a mining company. Compare it again to some of the best mining companies you have exposure to in DM. You're not giving up anything. Not giving up anything. You are actually getting pound-based currencies because I think it's listed here in London, in Australia, and in South Africa. Mobile telecommunications network, we put MTN, is what they call it, versus Verizon, one of the best mobile telecoms companies in the world. Covers itself in glory, no shame whatsoever. It's really important to identify these flying geese because mobile telecommunications company, MTN, together with Anheuser-Busch, together with all the Standard Bank, Beach Bolton, they operate in some jurisdictions which, if you had to go in and find the company yourself, you wouldn't know how to manage political risk in those countries. You wouldn't know how to manage industrial labor relations in those countries. You wouldn't know how to manage costs in those countries. Outsource it to some of these best flying geese companies and let them do the work for you. If you invest in one of these, for instance, if you invest in MTN, they're really investing in 21 African countries. MTN Ghana, for instance, has the highest margin of telecommunications in the world, MTN Ghana. MTN Ghana does more transactions, digital transfer transactions of money. MTN Ghana does more digital transfer of money than the entire formal banking system in Ghana. Good luck walking into Ghana trying to find a bank to invest in. Don't do it. Find a flying goose that has the levels of governance you can relate to, that is domiciled in a jurisdiction that can enforce global best practice and laws, that's very conscious of how its behavior is actually a precursor for future geographies it may want to enter. If it behaves well in other geographies, it may be allowed to enter and bid for licenses in other geographies. Again, you look at gold mining, a really interesting story, because AngloGold came from 1889 when it was founded, part of Anglo-American group, and it got unbundled out of that Anglo-American group, I think about 15 years ago. And as a focused gold mining company, it's now re-domiciled, I think, in London and in the United States. In the last 5 years, AngloGold has become the second best gold mining company in the world, with just exemplary capital allocation, exemplary governance, exemplary cost efficiency, asset productivity. It's been an amazing ride. The idea is not to play a theme. We don't play gold themes. You play a company's ability to arbitrage factors of production as it moves out of South Africa or India or Taiwan or whatever country into the rest of the world and participates in global seaborne trade. As we sit here today, AngloGold has 0 operations in South Africa, 0. They're all in South America and in the United States. You outsource its ability to navigate regulations in those markets really well. Again, what are you missing out on? Nothing. You get paid in dollars. It's listed in London, it's listed in South Africa. It's a dollar-based company. It sells gold in dollars. It pays dividends in dollars. Property and casualty, once again, Outsurance versus Progressive Corporation. And you can tell that Progressive Corporation is a good company. Very, very good company. But Outsurance gives it a run for its money. I think as we sit here today, Outsurance makes about 50% of its profits out of South Africa, the balance out of Australia. When Ireland turns profitable, which should happen in the next set of numbers, they'll make more out of Ireland than in South Africa. So what are you giving up on a currency basis? Nothing. Now let's talk a little bit about sitting ducks, because this is important. I've always asked myself, why, when you strip out companies that are really well embedded in global supply chains, when you strip out their performance, whether fundamental performance or share price total return performance, from the local stock market, and the local stock market looks cheap. It looks cheap perennially. Emerging markets will outperform for 5, 6, 7 years straight. I think they did up to 2010. And then they've underperformed, I think, from that period onwards. But why is it that when you strip out these companies that look out to the rest of the world, have a competitive advantage that they take to the rest of the world. When you strip those out, the local stock markets look cheap. So this chart here shows you, as we sit here today, case in point, in China, Chinese tech, Tencent, Alibaba, JD.com, the private equity valuation of ByteDance, nothing close to US tech. Nothing close. You can see where I've put a little box around those. That's Chinese tech. Why is Chinese tech that the world accepted and welcomed with such fanfare? Because China was a huge market, a growing market, penetration of e-commerce, switching from being a manufacturing country to being local consumption, and on and on and on and on and on and on. Why are they all stuck at a market cap that is less than $1 trillion? China is the second largest stock market, by the way. South Africa, the 17th largest stock market, by the way. Why is Alibaba, why is Tencent, why are they stuck? Now for that, you can go into a host of explanations, a host of reasons that are really centered on domestic policy. But when we look at it from an investment standpoint, Chinese technology is locked out from the global consumer. All the IT developers, all the coders, they work on either iOS, Apple technology, or they work on Android. How many developers are working on Harmony OS, which is the Huawei operating system, outside of China? China is not able to take its tech giants, convert them into flying geese, and get into the rest of the world, because the network effect of operating systems around the world having been monopolized by Microsoft, by Apple, by Google's Android system, leaves no room for another operating system. There are no customers for it. And Tencent has this app called WeChat, which does everything. It's a marvel of technology, by the way, way better than whatever Facebook has. Problem with that is when you already have WhatsApp on your phone, you have no other space and all your contacts on WhatsApp, and you have only 3 guys you talk to on WeChat. That's not where your attention is. So Chinese tech, as much as we read reports about China being technologically advanced and it's creeping up on the Western world, and Chinese tech is a sitting duck. And it's held hostage by Chinese domestic policy. And it's ceded ground to its competitors around the world from developed markets. Now, that's just an example of domestic companies that can be sitting ducks. I think you should really think about it that way and say, I would like to own companies that are flying geese, but if they're not flying geese, they're sitting ducks, then let's think about this a little bit more carefully. So one of the reasons why emerging markets, valuations of emerging markets are perennially low, 9, 10 times multiple, which looks appealing, is that government indebtedness in those countries is extraordinary. Now, of course, we know that the United States has incredible government indebtedness, but as a reserve currency, they enjoy certain benefits that, say, South Africa does not enjoy. There's no point any emerging market approaching the levels of indebtedness that the United States or Japan or anybody else has. So this chart here just simply shows an inverse relationship between CDS spreads, government spreads. As you can see, as they blow out, stock markets go down. So in other words, the costs of borrowing are high in emerging markets, not just for the government, but the cost of borrowing, which are reference rates for the corporate sector, are high. The idea is to bring those down in order for the market to go up. Now, here's a company, Capitec in South Africa. I'll be quick. Done a great job of being a local company, didn't expand, but has such competitive advantages that it's outperformed MSCI EM. 100% domiciled in South Africa. Incredibly entrepreneurial. Another one in Poland, which you're probably familiar with, Dina Polask, the equivalent of ShopRite in South Africa. Incredible capability, also 100% domiciled in Poland. You have to find sitting ducks that have found a way to minimize or to nullify or to blunt the impact of adverse domestic policies, if not economic growth. And last two slides here. South Africa has started to go down that journey. I think one of the speakers earlier was talking about governments in Latin America fixing their credit worthiness. It's one thing to say, well, copper is going to happen, iron ore is going to happen, so the fiscus will make money from taxing those companies. It's another thing for a government to get its house in order and reduce, you can see the chart on the right, that's the glide path of debt as a percentage of GDP in South Africa. So we're fixing that. And it's been phenomenal for government bond yields, South African government bond yields, which have been one of the best performing asset classes. But having said that, now the hard work begins because the bond market has benefited from that, from a reduction in government indebtedness. Now the equity market has to benefit from economic growth. And you look at the multiples in South Africa, forward PEs, less than 11, dividend yields at its highest point, the risk premium at its highest point. So the equity market in South Africa is the next leg up after the bond market. So thank you, ladies and gentlemen. That's what I wanted to share with you.
I think we're going to go to the next session. We haven't got time for questions.